and welcome to another special edition of the Sharesify podcast. Today, I am delighted to be joined by Salih Yilmaz. Great to see you, Salih.
Thank you. Great to see you too, and
Now,
thank you for having me.
a pleasure. Salih is a senior oil analyst at Bloomberg Intelligence, and I know investors will be really keen to to hear what you're thinking right now about the oil market. I watched your X video that you put out on the 2nd of March, right as the conflict started, and for everybody watching and listening, Salih said if this conflict drags on for any length of time, then oil's going to go to 100 to 110 bucks. Congrats, you absolutely nailed that because all through, I know it hit a high of 120, but basically it spent the whole of March, April, and May trading around 100 to 110. We're 3 months on, and oil's still trading close to $100, about what Brent's about 94 bucks, I think, at the moment. I mean, that's still 50% higher than it was at the start of this year. And the futures markets are sort of looking at what, 75, $80 in 12 months' time. So what's your take on it? How, do you think oil prices are going to stay high? And what's going to change the situation?
Great question. I mean, what's going to change the situation is still very much around Strait of Hormuz. It is still key to oil markets, and what happens there, if there is a reopening, if there is any sort of deal, is still key and paramount for what happens in the oil market. Will oil stay higher? I mean, I should say from the current levels, if there is any sort of deal, almost certainly oil will go down from the current levels, because I think we've got a good sense of this from the ceasefire or any of the ceasefire headlines that we've got over the last few weeks, where the market does think if there is some sort of resolution, it may not be a final deal, but if there is some
Mm,
sort of resolution, prices will retreat. But I think what you're getting to with that question is, will they be higher than where they were before the war? And I think
mm,
that's a great question. And I think the answer is almost certainly yes. We do think
okay.
that there is going to be a higher price floor, if you will, that emerges from this conflict. And there are a couple of reasons for that. One is, of course, on the supply side, we don't think that supply will immediately go back to where it was before the war. You know, um, even when the strait is opened, there is a huge backlog of vessels to go through. Those vessels will need to figure out insurance. And when it comes to the production facilities themselves, we really don't know what state a lot of those facilities are in. A lot of it has had to be shut in. They'll have to get back online. So this will take some time. On the demand side, we're going through a lot of the commercial and strategic inventories right now. So there will be a period of refilling those inventories. So that's kind
Mm,
of
mm,
marginal demand that's going to keep prices higher. And one final point I want to make is the geopolitical risk premium. I think even if there is a resolution, even if there is a deal, there will be a higher geopolitical risk premium attached to prices, and that's the kind of Hormuz premium. One thing that we may have forgotten, I mean, maybe back in the 70s, there was a level of Hormuz premium, and the market was thinking about Strait of Hormuz. But since then, I think for a very long time, we didn't have to worry about Strait of Hormuz much.
no,
But
no, no.
after this episode, I think the market and the market participants will. So when you combine all those things, I think oil price will stay high, if you will, higher than the pre-war levels, at least for a period of time.
That's so interesting that you think that kind of premium is now going to be embedded in the price.
Yeah.
That's really fascinating. You did touch there quickly on, you mentioned inventories, and somebody pointed out to me that they'd seen some worrying comments from a senior vice president at Exxon who was at a conference in New York and said inventories in the US are at really, really low levels. And if they aren't replaced soon and they get to a critical level, they were quoting Brent going to something like $150. Is that the scenario that we could be facing, do you think?
Um, I mean, broadly, I do agree, and this is something that we've highlighted in our research multiple times over the last few weeks. I mean, I don't really want to comment on price levels. That's
No, no.
really difficult to tell. But as I mentioned earlier, we've been kind of depleting inventories at a very fast pace. I mean, we estimate 4 to 5 million barrels per day. And I mean, because we had those inventories, that's been one of the buffers that has kind of tamed prices at much
Okay.
lower levels than where prices would have been otherwise, alongside some demand adjustment that we've seen. These inventories, again, both commercial and strategic, has been one of the reasons why oil prices haven't gone up much higher. But, by its nature, inventories are, of course, finite. And, that comment by the Exxon executive is broadly true. I think that, at some point, we're going to be much closer to what we call tank bottoms. And, when we say tank bottoms, I think people think, literally going down to zero inventories. That's actually not true. I mean, there are operational minimums for inventories. So I think the market would be in a lot of trouble before inventories get anywhere near zero. So again, it's hard to tell exactly when, but it is kind of a bit of a countdown if the strait doesn't reopen. And then if we do get to a point where, currently we're in a deficit environment where, there is inventories and we're going through those inventories. But once and if we run out of those inventories, then the market would go from pricing that deficit to pricing, actually not having those physical barrels that the
Yeah, yeah,
market
yeah.
needs. So at that point, I think there's also an element of panic rally that you have to think about, where the market would then really start panicking. And then, I mean, 150, 160, it's hard to put a number on that. But yes, I generally agree that the prices could spike a lot more than they did so far.
Then they have, so yeah, and that could be, I don't think investors are kind of pricing that risk at all at the moment. And that leads me to another question which somebody sent in, which is great, which is energy markets, like all markets, are about supply and demand. And there's an old saying that the cure for high prices is high prices. So is it possible, do you think maybe high prices would choke off demand to the extent that that eventually has to bring energy prices down? I mean, I think Goldman strategist has been suggesting this recently.
Yeah. Absolutely, and I think it's already happening. But I should say that I love the way that you framed it. The cue for high prices is high
High
prices, and I think
prices.
generally that's true. But I mean, I should say that this is, I mean, some call it demand destruction, some have called it demand adjustment. But we've already been seeing this, and I think. Apart from the inventory depletion that we've had, demand destruction has helped the market kind of find a new balance in this environment. And I mean, our estimates are pointing to something like 3 million barrels per day of kind of demand adjustments lower at the
Wow.
moment,
Wow.
which is pretty significant. And some of the
Yeah.
evidence that we have for that is, some reduced flight activity, especially in Asia. We
Mm.
know there's been kind of softer petrochemicals industry demand, and perhaps most importantly, it's hard to put a number on this, but what we've observed is China importing a lot less crude
Oh,
than it
really?
did previously, which has helped the oil market find this new balance massively. And I think that adjustment has been much bigger than what the market has been expecting. And I think it's been partly kind of fuel switching, partly switching to coal, especially in the petrochemicals space. But I do want to highlight that, what we've kind of seen so far is probably the lowest hanging fruit, if you will, kind of the easiest part of the oil demand adjustment that's been adjusted has already been adjusted. So usually the first barrels to be lost are kind of the discretionary travel that
Mm.
we're seeing from like less travel activity, marginally lower industrial consumption, and perhaps some of the less profitable petrochemicals activity. But after those kind of barrels are lost, that demand, that kind of frothy part of demand is destroyed. I think the rest of demand is a lot less elastic. So it would be a lot more painful to be destructing
Yeah, yeah, yeah.
marginal demand from where we are currently.
Oh, that's fascinating. That's really great insights. Thank you. Now, you're in Dubai, and I know you're an OPEC watcher. And somebody else has asked, what did you make of the news that the UAE was going to leave the cartel? We haven't mentioned OPEC, but UAE is, I think, the third biggest producer, and it's been a member for 60 years. So,
Right.
what's your take on that?
Another good question. To be honest, it wasn't a huge surprise. I mean, I should say it shouldn't have been a huge surprise because they've been quite vocal about their
Right?
frustration with the quotas. But it was one of those moments because I was in front of
Yeah.
my computer and I kind of like stared at it for a couple of minutes, stared at the headlines when it hit the Bloomberg terminal because again, not a huge surprise, but pretty historic. And and I would say one of the main reasons is their production capacity is much higher than where their quotas were, and this was one of the reasons why they've been so frustrated with these quotas.
Okay.
And they've been and they still are investing even more to expand their production capacity, and they have plans to invest even more in the coming years because I think they really want to monetize their reserves as fast as possible. And what they've been arguing was that this was a quite opportune time to do it because the strait is closed, there is this big disruption, so the announcement wouldn't really do much to prices because before the war, if they announced it, this would almost certainly push prices
Mm,
lower.
mm,
But because of the situation in the Middle East, they argued that it was a good time to do it. There would be almost no impact on prices. But perhaps thinking beyond the very near term, what this means is that now there is a significant amount of supply that this big producer can bring into the market. So beyond this war, if and when the strait opens, there's going to be significantly more supply coming into the market, and that's obviously bearish for prices. And to the second part of your question on kind of what this might mean for OPEC, I mean, you're right that the UAE is the third largest producer in the group, but perhaps more importantly, they're the second largest spare capacity holder. And spare
oh,
capacity is arguably more important when it comes to OPEC policy because it means they were the second member nation that could hold off more supply, basically only after Saudi
mm,
Arabia. So that makes them quite important to the group. So them exiting the group almost certainly makes the group weaker when it comes to their policy management. But I've gotten a lot of questions from our clients on, does this mean the end of OPEC? And I've been covering this space for a long time now, and this has come up this has come up so many times.
yeah.
I wouldn't say this is the end of OPEC. I think the group has been tested many times before. It will make the group perhaps weaker in terms of how much supply they will be able to control and how powerful their policy management can be. But it's still a very big group of a lot of important and big producers. And as you know, currently there's the wider OPEC Plus group that includes
Yes,
other
yes, yes.
producers like Russia, like Kazakhstan. So I wouldn't say this means that the group dissolves, or I wouldn't say this is the end of the group at all.
Brilliant. I've got so many questions, so you're going to have to come back, I'm afraid. We're going to have to
Yeah,
book you in again.
happy to.
I'm afraid we're out of time. It's been absolutely brilliant having you on. Thank you so much. Thank you to all our watchers and listeners as well. We'll be back with a regular podcast tomorrow. So from us, bye for now.
Thank you.